time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Dollar General, symbol DG on the New York Stock Exchange, is a discount retailer providing various merchandise products across the United States. The company has over 19,000 stores across 47 states, and those are located within 5 miles of 75% of the U.S. population. The company is currently trading at $164 a share with a market cap of $36 billion and has a dividend yield of 1.44%. However, the stock was recently trading quite a bit higher. Prior to the Q1 earnings, the stock was trading just above $200, which was already depressed throughout the last year. But it fell 18% overnight, a significant drop for a defensive company. That was what you would expect on a tech company having bad earnings. The market reacted negatively to the relatively weak Q1 earnings, but more importantly, to the company really downgrading its guidance for the fiscal year. So a quick rundown on the last quarter, so Q1 2023, net sales increased by 6.8% to $9.3 billion, and that's a 1.6% on same-store sales. So that's effectively if they had the same amount of stores because they opened stores throughout the year. Gross profit margin had a slight uptick to 31.63% from 31.29%, attributed to just better supply chain. Because remember, the year before, we were seeing very dangerous supply chains for many of these merchandise companies. Operating profit was effectively flat at $741 million compared to $746 million in the prior year, whereas EPS fell to $2.34 from $2.41, part of that being because of higher interest expense. But moving to the more important company outlook, Dollar General just dropped its expectations of sale growth to 3.5% to 5% range from the previous 5.5% to 6%. Same-store sales are now expected to grow at only 1% to 2%, previously 3% to 3.5%. And EPS, a significant drop from now expected to decline by 8% to flat, and that was previously expected to grow from 4% to 6%. So a massive change on our EPS line. As well, the company is no longer planning to repurchase shares in the year to keep its leverage ratio within their 3 times EBITDA target. So that's EBITDA before rent. Previously, the company expected to repurchase $500 million worth of shares in the year. The downgrades really come off the back of a weak macro environment. The company is seeing weak customer demand compared to what was previously expected. We've looked at things like weakening customer spending, increased customer debt, and this is really the Dollar General seeing the acclimation of these macro environments. As well, the company specifically cites lower tax refunds and SNAP payments as specific causes for decreased spending, and those coming in the start of the year, and that's why they're starting to realize that at the end of Q1, so you didn't have it fully realized in this quarter, but then going into Q2, which they talk about, they're seeing weaker sales. Now, shifting to valuation, Dollar General now trades at 16 times the midpoint of the current management fiscal 2023 guidance compared to 18 times at the previous $200 a share before the last quarter. So we saw both an earnings contraction and a multiple contraction when taking into the change of the share price and the expectations change. Dollar General has historically traded at a bit of a premium, not a massive premium, but a bit of a premium compared to peers, and now is closer to in line, but even still at slightly above, depending on exactly what you're considering as peers. So, our take. The company has, in theory, a benefit of being a defensive stock, meaning it's resilient to customer downturns. However, in reality, we just haven't seen that. The fundamentals in this case, in this sort of economic and macroeconomic scenario, we're not seeing the textbook defensive stock where they're resilient in their earnings. We're seeing actually the weak customer demand really hit them. And it's still fluctuating, it's still playing out. We're not sure how long this is going to last, of course, and what the degree of fluctuation is. You can see previously I said they're expecting to either decline their EPS by 8% to flat. That is a big range for EPS compared to what they were. I think it was 2% before the range, and now we're seeing an 8% range, just to give it an idea of they're not really sure what's going to happen throughout the year either. As well, the valuation is now expecting the higher risk compared to previously expected. That's where we're seeing that multiple contraction. And so that multiple expansion, even if the EPS starts to come back up, the market might not even want to value it at that same 18, 20 times we were seeing before. It might stick into the mid-teens. So even that is a risk on the price. Although I don't see the company really appealing at this time, it could be potentially in the future if the stock price continues to be depressed and we see the macro environment vastly improve compared to what it is, as well as the outlook of the macro environment, and then that going down to the company's EPS growth as well as sales growth. So hold off for now, I would say, but it could be potentially worthwhile another look in the future.
Yeah, the dollar stores generally have typically in a recession held up better, so they are areas to look for to kind of invest in during those periods of time. So if we could get it at a reasonable price, then it could be an interesting. Now there's a number of different players in this segment, so we'll have to analyze all of them against each other, do the comparables. But yeah, it's a good summary of that company.